Long-term care insurance was supposed to protect these three real Americans who did everything right, bought coverage years before they needed it, paid their premiums without missing a payment for decades, and all three ended up blindsided anyway. Angela Jemmett and her 5 brothers paid long-term care insurance premiums for their 91-year-old mother for 35 years, and when she finally needed care, the policy turned out not to cover the home health aides that allow her to stay in her own Sacramento home. That care cost the family $4,000 a month out of pocket, on top of every premium dollar they ever paid. Lawrence Howard of Amherst, Massachusetts, paid more than $50,000 in premiums over 20 years on his Mass Mutual policy. And then in 2024, he received a letter telling him his annual premium would increase by 37.5% per year for 4 consecutive years in a row. By 2028, if every increase gets approved, he'd be paying $11,375 a year, which works out to a 257% increase from what he was paying just 4 years earlier. Laura Lunsford of Sandy, Utah, had a simpler reaction when her combined premium with her husband jumped from under $3,800 a year to over $5,700, with more increases on the way. Her words were direct: "It's a giant bait and switch." Those are 3 real stories, and they matter enormously for anyone making this decision. But they don't tell the whole picture, because 70% of Americans turning 65 today will need some form of long-term care at some point in their lives, and a single year in a private nursing home now costs, on average, over $127,000. This video is going to answer one question: is long-term care insurance a smart financial protection for your retirement, or a broken product that's doing more harm than good? The facts, the numbers, the history, and your real options. All of it is here. The first thing you need to understand, and this catches a lot of people completely off guard, is that Medicare does not cover long-term care. Medicare will pay for short-term skilled nursing care after a hospitalization, but the ongoing day-in, day-out help that most seniors eventually need, bathing, dressing, getting to the bathroom, eating, that's called custodial care, and Medicare won't cover a single day of it. The other government option, Medicaid, does cover long-term care, but qualifying for it comes with a brutal condition. You have to spend down almost all of your assets first, going broke before the government steps in. And once you're on Medicaid, your facility choices narrow sharply to only those that accept Medicaid payments. One alternative worth knowing about is your state's long-term care partnership program, available in most states, which allows you to protect some assets while still qualifying for Medicaid if private insurance benefits run out. So the gap is enormous. Medicare won't help with the care most seniors actually need, and Medicaid requires financial ruin to access, which meant that somewhere in the mid-1980s, private insurers saw a market worth entering. That's where this product came from, an attempt to fill a gap that the government left wide open. And for a while, it seemed to work. But here's the thing: the way insurers priced those early policies turned out to be one of the most costly miscalculations in the history of the American insurance industry. Long-term care insurance first became available in New York State in 1988, and through the 1990s, the market expanded fast. Insurers competed aggressively, offering generous policies and paying agents commissions that ran 40 to 60% of the annual premium, some approaching 100%, which created a sales boom built partly on financial structures that couldn't hold. In the year 2000, 608,000 new individual long-term care policies were sold in a single year. That was the peak, and the industry never came close again. The problem was pricing. Every policy sold in the late 1980s and 1990s required actuaries to predict costs 20 to 30 years into the future, with almost no historical claims data to draw from, and 3 of their core assumptions turned out to be wrong simultaneously. First, insurers expected that many policyholders would eventually stop paying premiums and drop their coverage. Those dropped policies cost nothing to pay out, and the lapse rates never materialized the way they'd been modeled. Second, policies were priced assuming investment returns around 5%, and when interest rates collapsed in the 2000s and stayed near zero for years, half the income those models counted on simply evaporated. Third, people lived longer than expected and used their benefits more than expected, which compounded every other error at once. Penn Treaty is the clearest example of where this leads. At the time of its collapse, Penn Treaty ranked as the 10th largest long-term care insurer in the country, and in January 2009, it was placed into rehabilitation, a legal precursor to liquidation. The Pennsylvania Insurance Department determined that premiums would have needed to rise by 300% to keep the company alive, which regulators refused to approve, and by the time Penn Treaty was wound down, its liabilities exceeded its assets by $4 billion. AM Best, the insurance rating agency, described the failure in precise terms: policyholders lived longer than expected, Medical expenses came in higher than anticipated, and lapse rates ran far below what the models had assumed. By 2012, every insurer offering unlimited lifetime long-term care coverage had pulled that option off the market entirely. By 2020, the number of companies still actively selling traditional long-term care policies had dropped from more than 100 at the market's peak to fewer than a dozen, and annual sales had fallen from 608,000 policies in 2000 to just 49,000. The New York State Department of Financial Services put it in writing in June 2023, releasing a report that declared the long-term care insurance market nationwide to be, in their words, in crisis due to historical mispricing, which has led to ever-increasing premium rates and insurers leaving the market. That's a state regulator, not a consumer group, using the word crisis. Before getting to whether insurance is worth buying, the cost of care itself needs to be on the table, because the numbers are not what most people expect. According to the Genworth CareScout 2024 Cost of Care Survey, a median assisted living facility now runs $70,800 per year. An in-home health aide, someone coming to your house, tops $77,000 annually. A semi-private nursing home room costs $111,325 per year, and a private room averages $127,750. Those costs are also accelerating. Assisted living jumped 10% between 2023 and 2024 alone, and skilled nursing rose 7% in that same 12-month window. The federal long-term care insurance program projects that if inflation holds at 2.54% annually, a nursing home room costing $112,420 today could cost $186,000 within 20 years. A 2022 study from the Department of Health and Human Services estimated that seniors who require long-term care will need an average of $138,000 in total long-term support services across their lifetime, with about 14% of seniors paying more than $100,000 entirely out of pocket. Now, the likelihood side of the equation: 70% of Americans turning 65 today will need some form of long-term care in their lives, 22% will have needs lasting more than 5 years, and 51% of women over 65 will need paid long-term care at some point, compared to 39% of men. Women also spend approximately 2.8 to 3 years in a disabled state near the end of life, a longer window of need, which is part of why their insurance premiums run higher. And the number that cuts the other direction: 47.3% of people who reach 65 will need no paid long-term care at all, nearly half. This is a real risk, not a certainty, which is exactly what makes the decision so difficult. To qualify for benefits, most policies require you to need help with at least 2 of the 6 activities of daily living: bathing, dressing, eating, toileting, continence, and transferring, or to have a cognitive impairment like dementia or Alzheimer's disease that makes you unable to protect your own health and safety. This is the benefit trigger that determines when your coverage actually kicks in. A 60-year-old man buying a traditional standalone policy today with a $165,000 benefit pool and 2% inflation protection would pay roughly $2,060 per year. That same coverage for a 60-year-old woman runs about $3,325, which is 40 to 50% more because women live longer and file claims at a higher rate. For a couple, both age 55, purchasing traditional coverage in 2023, the average combined annual premium came to $5,850. Importantly, policies that meet HIPAA requirements allow premiums to be tax-deductible as medical expenses and benefits to be received tax-free. None of those premiums are guaranteed. That's the part the sales materials don't always make obvious. With a traditional standalone policy, the insurer can request rate increases from state regulators over time. And the stories of Lawrence Howard and Laura Lunsford from earlier in this video are not exceptions. They are a documented industry-wide pattern that has repeated for 20 years. The New York DFS report confirmed it. The carrier Exodus confirmed it. AM Best analysts projected that Genworth, the largest name in this business, would need to continue raising rates for years to reach what they called economic break-even. When the biggest company in your industry needs to keep raising prices just to break even, that tells you something about the product's structural health. Because of the premium increase problem, a different kind of product has been taking over the market, and it's called a hybrid life insurance policy with long-term care coverage built in. The structure works like this. Instead of paying an annual premium that can be raised, you pay one lump sum upfront or fixed installments over 5, 10, or 15 years, and those payments are locked for life. In exchange, you get 2 things at once: a pool of money to draw from for long-term care if you ever need it, and a death benefit paid to your heirs if you never use the care coverage. That second piece directly addresses the fear that stops many people from buying traditional coverage in the first place: the fear of paying decades of premiums and dying with nothing to show for it. A real example from the American Association for Long-Term Care Insurance. A 55-year-old woman paying a single lump sum of $76,740 could receive $180,000 in long-term care benefits, a $120,000 death benefit, and a 3% annual inflation adjustment on top of that. Without the inflation rider, that same coverage drops the required lump sum to about $54,000. Major hybrid products in this space include Lincoln Financial's MoneyGuard and Nationwide's Care Matters, which together account for a significant portion of hybrid market sales. The market shift is substantial. Hybrid policies started outselling traditional standalone policies in 2014, and by 2025, over 653,000 hybrid life and long-term care policies were sold in a single year, more than double the roughly 307,000 sold the year before. The trade-offs are real. Hybrid policies cost more upfront. The lump sum represents money that could have been invested elsewhere, and if care costs keep rising at 10% per year, a 3% inflation rider won't keep pace. But for people who want predictable costs and don't want to risk losing everything they paid if they stay healthy, the hybrid structure addresses the two biggest complaints about the traditional product. Financial advisors and insurance specialists do have a shared view on this, and it comes down roughly to asset level, below about $250,000 in assets. Premiums for meaningful coverage become difficult to afford, and Medicaid may ultimately serve as the fallback regardless of what you do, which makes the insurance a financial strain without a corresponding payoff. Above about $3 million, the math shifts the other direction. Absorbing care costs without catastrophic financial damage becomes realistic, and self-insuring makes more sense than paying premiums to a company that may raise them anyway. The people this product was built for sit between those two numbers, roughly $250,000 to $3 million in assets, enough to lose that a multi-year nursing home stay could genuinely devastate the finances, but not so much that the damage can simply be absorbed. That's the target buyer, and that's who benefits most when the product works as intended. The best window to buy a traditional policy runs between ages 55 and 65, early enough to lock in lower premiums, late enough to avoid paying decades of premiums before the risk becomes real. Buying after 65 means dramatically higher rates and a sharply higher chance of being declined due to health conditions, because about 22% of applicants between ages 60 and 69 are turned down for health reasons, and that rate climbs with every additional year. One data point worth considering from the industry's own records, a study of actual claims across 45 years and 295,000 individuals found an average total claim value of about $72,000, which is less than a single year of nursing home care at today's prices, meaning the need is real for most claimants, but it is also finite for most of them. Congress attempted a national solution in 2010. The CLASS Act, the Community Living Assistance Services and Supports Program, passed as part of the Affordable Care Act, and was designed to create a voluntary national long-term care insurance program. By 2011, the Department of Health and Human Services concluded it couldn't work. The problem was adverse selection. Only people who were already sick or expecting to need care would sign up voluntarily, which meant the risk pool would be too small and too expensive to sustain, and the CLASS Act was eventually repealed without ever paying a single benefit. One state decided to act on its own anyway. Washington State enacted the WA CARES Fund in 2019, the first and, as of early 2026, still the only functioning public long-term care social insurance program in the United States. Workers contribute 0.58 per $100 of wages as a payroll tax, and in exchange they can receive a lifetime maximum benefit of $36,500 indexed to inflation, covering home care, assisted living, nursing home stays, home modifications, and transportation to medical appointments. The fund accumulated over $1 billion in reserves in its first year of collection, sits projected to remain solvent through 2098, and in November 2024, Washington state voters rejected a ballot measure to make the program voluntary by a margin of 55.5 to 44.5%. First benefits are scheduled to begin July 1st, 2020. The honest criticism of WA Cares belongs here too. $36,500 amounts to roughly one-third of a single year in a nursing home at current prices, which means it's a contribution, not a solution. New York, Massachusetts, and California have all commissioned actuarial studies to explore similar state programs, but none of them have launched. And on the federal level, nothing has replaced the CALAS Act. Every family outside of Washington state is, for now, navigating this entirely on their own. Here is the honest answer, built entirely on the evidence. Traditional standalone long-term care insurance carries documented risks that have cost real people real money. Premium increases are not hypothetical. They are baked into the industry's financial history, confirmed by state regulators, and projected to continue by the rating agencies that track these companies. The market has contracted from more than 100 carriers to fewer than 15. The policies have gotten less generous even as care costs have climbed. At the same time, the cost of needing years of care without any coverage is potentially financially catastrophic. A private nursing home room at $127,750 per year, assisted living at $70,800. A home health aide at over $77,000 annually, those are today's median prices, rising at 7 to 10% per year, outpacing almost every inflation assumption built into the policies currently being sold. The product that makes the most sense for most buyers today is no longer the traditional standalone policy. The hybrid fixed premiums locked for life, a death benefit if you never need care, and a real pool of coverage if you do, addresses the core problem that turns so many policyholders' experiences bitter. Not perfect, but structurally sounder than what came before. For people sitting in that middle asset range, roughly $250,000 to $3 million, the real question isn't whether long-term care insurance is worth it in the abstract. The better question is whether you can afford what happens if you don't have it. 70% of people turning 65 today will need some form of this care. A private nursing home room costs more per year than most Americans hold in accessible savings, and neither Medicare nor Medicaid offers a clean or dignified path for the middle class. Tom McInerney, the CEO of Genworth Financial, the biggest name in this industry, put it plainly: one way or another, taxpayers are going to have to pay more for the long-term care needs of the baby boomers. He's right, and until a national solution exists, every family is making this call on their own. If you are between 55 and 65 in good health, and somewhere in that middle asset range, this is your window, and it won't stay open forever. Not because long-term care insurance is a flawless product, it is not, but because the alternative, paying over $127,000 per year out of pocket, or spending down everything you have to qualify for Medicaid, may cost far more than any premium ever would. That is the real math, and now you have it. Make sure to subscribe to not miss any other videos, and I'll see you in the next one.